Hey there, Wealth Secret Seekers. John here from Canadian Wealth Secrets. Hey, this is a special Secret Sauce episode where Kyle just recently met with a client of his who asked a lot of great questions about the pass-through structure that we've shared here on previous past episodes for incorporated business owners. This particular individual, in a way, as a case study, has an incorporated business. One of the shareholders, mostly the core and sole shareholder of this business, has about 2 million-ish in retained earnings every single year. Now, why I say that is because it brings up questions around like, how do I maintain these retained earnings, or how do I grow these in a tax efficient way? That's why this particular individual was on the call with Kyle, and this individual asks a number of great questions that we're going to outline here and provide these frequently asked questions around how to use this pass-through structure, how to set it up, what are some of the barriers around using a whole life policy as a pass-through structure in incorporated businesses for tax efficiency and generating tax-free cash flow for those shareholders. So we're going to address those questions here in this episode. We're going to start off with this particular question, which is what is the passive income threshold that businesses have? And this particular individual was looking to see, like, what are the tax rates for generating passive income? Kyle talks about that issue and also say the tax clawback rule. Here we go.
There's two problems with passive income. Okay, so the first one, that doesn't impact your active income at all. But the first general issue is that it's taxed already at 50+%. So for example, the easy example is, say, a GIC. You had said you're fairly conservative. So a conservative business owner might say, you know what, I'm going to buy a GIC inside the corporation. And, let's say it was $1 million of GICs and you were earning 5%, let's say. You probably can't get that anymore. It was possible maybe a year ago, but now those rates have come down. That 5% that you're getting out, you go, you know what, like, that's not bad. That's like, $50,000 coming out. Problem is that 50,000 is really only 25,000 because the government takes the other half. Now, to address the other side, so that's the initial problem. And if you try to compound that, you can imagine, right? If you're compounding $25,000 instead of 50,000, that has a significant, negative effect on the overall growth. So the other issue is what you referenced, which is if you have too much passive income inside the corporation, they'll start clawing back. They call it the grind down rule. And basically what that's going to do is that's going to actually grind away at your active income tax credit, that small business tax credit. So basically every, once you hit $50,000 of passive income, then every $5,000 after that, it'll slowly grind down your active business tax credit. So we try to avoid that. There's ways we can do that. We have strategies to avoid that. But ultimately, I would argue that most passive income assets they're being taxed so heavily inside the corporation that it becomes problematic in and of itself, like even before we even go down that rabbit hole.
Okay, the next question this client asked was, when you think about your retained earnings, this particular person had around $2 million in retained earnings every single year, and looking to, grow grow that into retained earnings. They wondered, what makes sense? Like, do I put all of my retained earnings into this pass-through structure, or should I put some? What's the optimal number? Like, how much should I be contributing to a whole life policy to use as a pass-through structure for tax optimization and wealth building growth? That's what we're going to answer here in this question.
What is the sweet spot in terms of these cash premiums? Given that I've got such a large amount of retained earnings, why would I put $50,000 in per year versus $500,000 per year? Like, where's the sweet spot, or where's the logic or rationale in the value?
Definitely. This is a great question. So the real goal, so a couple things. First off, there's what is most rational. The most rational thing to do is to try to get as much of that money in there as possible, as soon as possible. The emotional thing, though, is that that would require your premium to be a lot higher. And that can be scarier for someone. And they might just never pull the trigger because they're like, hey, that would be the rational thing to do. But they don't know if they feel comfortable with a $500,000 per year premium. Some people are like, nope, this makes perfect sense. I totally get it. I feel good about it. Let's do it. So someone might start with something smaller. The problem with doing something smaller, like 100,000, is you only get $1 million in there after 10 years. You got 2 more decades, or a decade and a half more to go just to get your 2.5 in there. That doesn't account for any new retained earnings you generate. So I would argue for someone like yourself, 100's too small, but is better than doing nothing at all. Ooh, that's like a rhyme. Look at that. If we look at, say, 300, so 300 would get 3 million in there over a 10-year runway. I like that number because it gives you a lot of flexibility. The earliest we can offset this policy, meaning the earliest we can stop paying premium, is about 5 years in a policy. So you could put it in there for 5 years and then stop paying. You got 1.5 in there. That leaves this extra 1 million there that maybe, I don't know, who knows, maybe there was a business emergency or you wanted to spend it on something. I have no idea, but gives you a little more flexibility. If you choose to go the full 10, you can get, 3 million in there. But the beautiful part is that you don't actually, this is the same policy, different funding scenario, meaning when you sign up for a policy, you're saying, I'm going to commit to paying this for at least a certain number of years. The number is typically a 5 to 10 year runway, but you get to decide and you don't have to decide up front. The other thing that I've not shown you is that with these policy designs, there's also a minimum amount that we can fund. So for example, you might choose to start funding 300,000 a year, but then later decide to do 115 in a year or 125 or 225. You have the flexibility in any of these years to pay between these amounts. And these numbers are fairly scalable. So what I mean by that is that if I doubled the maximum, my minimum would double. If I half the maximum, my minimum would half.
Kyle, why is one column called guaranteed required annual premium and the other one's called cash premium?
That's a great question. So this one is, they're saying when you start this policy, if you get approved and you say, yep, sign me up, they're expecting a check from somewhere between this amount. And then what I'm showing here is what we're going to fund. This is what we decide to fund, but I'm also showing that that is truly the maximum that we can fund here. So this column's kind of, we'll call it what you chose to do. So for example, I want to show you an example. The minimum's this number, the maximum's this number, but really this column represents what you chose to fund. So you chose to go 300 for 5 and then 115 for 5 and then turned off the premium, never put another dime in there. That's what this scenario is showing here without me adding a separate column showing the maximum, which is the same number as 300. So there's some fair bit of flexibility when you're looking at these types of policies in terms of the minimum and the maximum. So when I go back to the $100,000 example, there was also a minimum there. There's the minimum. I just didn't show it because I didn't want to distract or make it too overwhelming. Here's $1 million policy I ran for someone, right? $1 million max funded. Here's the minimum they can contribute with that policy. And again, we usually aim for a 5 to 10 year runway, except this policy could be offset after year 4, but he's planning to do it for about 10 years is his goal.
Okay, the next question here asked is, and this is a common question when we think about the future and we're thinking about using the pass-through structure. Oftentimes when we use our pass-through structure and we basically are putting our retained earnings every year into a whole life policy as premiums. We have the cash value. We're going to leverage against that cash value to buy assets. When we do that, we create a system. We create a machine that helps us generate our wealth, but also creates it in a tax efficient way. So this particular person was asking, if I'm planning to leverage against my policy, like right now, interest rates might be, 5%, 6%. Maybe I'm getting 7% interest rate when I borrow or I leverage against that cash value. What happens in the future? Like what happens if interest rates rise and all of a sudden the interest rates are outpacing, say, my investments? Is that a concern? Like I'm very concerned about when interest rates rise, whether I'm going to be underwater. And we address that here.
This person could pull 160, assuming the interest rate is 5%, let's say, and in 11 years. We don't know what the interest rate's going to be, by the way. I cannot predict that. If I could, I wouldn't do this for a living. I would go make money doing something else, making predictions. But what I can say is that your cash value actually grows more when interest rates are higher, and it grows less when interest rates are lower, which is a good thing for borrowing because we want them to work together. So if we assume 5% here,
cash value grows obviously more when interest rates are higher.
Yes, because the actual growth of the policy is heavily based on interest rate environments, which is actually by design for why we pick this type of permanent insurance, is because if leverage strategies are usually going to be utilized at some point, you don't have to, but like I had mentioned, most business owners want to know that they could leverage against the policy for business growth, investment, personal income, whatever it is that they want to utilize the leverage for. We don't want them working like this, right? Like we want them to kind of stay in tandem, which means let's pretend we went back to the 80s. Okay, because that's usually the biggest fear for anyone who's lived through the 80s, right? So you probably remember that was not fun. But the problem or the benefit, I suppose, is that even though you'll borrow at a higher interest rate, your actual cash value is actually going to be much higher than we anticipate as of today, because these are based on the interest rate environments of this past decade, basically, which has been fairly low interest rate environment, right? If we look over the last 10 years, we've had 2 years of this little blip, which was a 30-year high, which is kind of crazy to think about. Policies grow based on interest rates. So if we go back and look at the historical growth rates, back in 1990, Sun Life, Equitable Life, Canada Life, they were all paying 10+% in the returns for their cash values. Why? Because they were investing in the same environment, which was high interest rate environment.
This question is probably the most commonly asked question about using leverage against your cash value for a whole life, against a whole life insurance policy, whether it's at the personal level, whether it's at the corporate level, no matter what. If you are using this particular asset to buy other assets or invest in have capital available, the biggest hurdle is to overcome the idea of leverage and the idea of basically this idea that you think that you are borrowing your own money. You're leveraging against your own money. Like, why would I have to pay interest to access my own money? Super common question, and is also one of the biggest barriers folks in terms of business owners or personal on the personal side have against their wealth building capabilities. It almost as if we can't get over the idea of leverage, then we actually restrict ourselves. So Kyle answers that well here. Here we go.
And it's just interesting about the whole leverage aspect and having to pay interest to have access to the money. Obviously, if you're leveraging against it, you're paying whatever interest rate you are. Yeah, see, that's where.
Yeah, that's where the wheels sometimes fall off, right? Because then you go, well, wait a second, why do I want to do that? And what I'll remind you of is that I am paying, say, 5% or 6% interest instead of 39% dividend tax.
Yeah.
That's like the big one. And remember that when you do borrow against this asset, it keeps growing by that 4 to 5% anyway. So if I'm not borrowing in the interim, then it's just growing tax-free. And then when I do start to borrow, that amount that I'm borrowing, it's like the compound interest curve can never quite catch up. So imagine this cash value kept going. for quite a while. And this person's only starting to borrow, let's say in year 10 or sorry, year 11. They start to borrow 160 out of this thing, and they will never run out of any money. Even though there's a loan against this policy, they'll never run out of money all the way till age 100 if they were to do that. This is a 51-year-old, starts borrowing out at 61, 160,000. That's the same as about a $262,000 income every year based on this tool. Even though, and we have accounted for the interest because the tool keeps growing and compounding, and we're getting this cash flow in our personal pocket without paying personal taxes. So you're getting sort of a double whammy.
So the equivalent of 262 because of the tax rate and all that. But if you scroll down to, the loan balance is the loan balance relative to the death benefit. Where does that?
So your death benefit by 75 in this case, this particular person's case, 9 million of death benefit. You've racked up $3.6 million of loan, which, thought of another way, that would be like you taking out 3.6 million, from your RSP or your company slowly. You just wouldn't be able to do as much as you are. You wouldn't be able to do that and have it last. So here there is a loan, but your death benefits here, your cash value, my cash value is 7 million. I've only borrowed 3.6 of it, and my death benefit's 10.9. So the net is still 7.3 million to the estate. And if I keep going and I go, let's say I make it to 85, I want to go longer. You want to go longer. I know that, right? We both want to. I go to 85. My cash value is almost 11 million. My loan balance is 8 million. And my death benefit's 13.7. I still have a $5.7 million death benefit left to the estate. Like some people, when I get on calls, they're always like, I don't care about my estate. I said, well, then you better start spending faster. Because what if you die when you're 85? Like, you're going to have to, you better spend faster, like, don't make it last till 100 because you don't know if you're going to make it to 100, right? But we do that because we want to be conservative and, in our estimates. And ultimately, the other piece that's really important to note is nobody said you had to do 160 every year. You might choose to go, like, I only need like 125 a year. Like, if I do that, obviously you're going to have an even bigger estate left over even at age 100, right? You have 4.4 million left. And then the other nuance is, hey, listen, nobody said you had to take the same amount every year. You might choose to take larger amounts to age 70 and then lesser amounts, beyond that, right? We can run all of those, but this is very generic.
What happened if someone took, say, 250? What would happen to the numbers down the road?
Yeah, so let's see what 250 would do. So what I would tell you is this. Your 250 is going to work until it doesn't work anymore. And what that usually means is your cash value and your loan balance have sort of, you've gone over. So 250, what ends up happening? Your cash value is 8.7. We got 8.6. You're at about done by age 81. If you did. Now, you can just stop taking income. Okay. And I want to show you what would happen instead. So basically what would end up happening is something like this. In a realistic scenario, you did 250 per year. Remember, that's not taxed, right? This money is not taxable. So that's like taking 409 a year, right? Now, basically what ends up happening is just this loan balance just has to be maintained, right, by the cash value. And you still have money left over for the estate. So even if you still make it, oh, shoot, we did run out by 94, I might say, you know what, age 79, now you're getting closer, right? If you get to this part, you might have to liquidate some other assets in order to, or to pay down a little bit of that loan. So that's why I always say being a little more conservative is better. If you went 150 in the 79th year, but ultimately you get to decide, right? The goal is just trying to make sure that you don't outlive your money. That's the key.
So the loan balance, so obviously the loan balance can never be higher than the death benefit.
So the loan balance won't be higher than the death benefit because your cash value is sort of what this loan is being based on, right? So they keep forwarding you the money based on your cash value.
Oh, I get you. Okay, so the
Yeah.
loan balance can never be higher than the cash value.
Exactly, which in a lot of ways is sort of a blessing in disguise. Like,
For sure.
as a fairly, I would call myself fairly conservative, even though I like investing in real estate and such. It's like I never over leverage. I never, I don't like to put myself in risky scenarios. I love the fact that that's sort of a build in here is like I can never like be upside down at the end. Whereas we go back to my example, my real estate example over here, where we went, well, wait a second. Remember the real estate example where we went, you could actually be upside down by borrowing against a property,
Yeah.
and then having the capital gains actually be too much.
But you can't
Where
do that here.
you can't, it's just not
Yeah.
by design.
Yeah.
It's not going to happen, which is great.
Yeah.
In this video, Kyle's going to answer how long, you should be continuing making premium contributions. Like, do you have to contribute to that policy forever? Can you contribute for a set period of time, which is kind of called an offset? Can I offset it after year 10, which means kind of turn the premiums off? Can I do it in 5 years? Can I do it in 20 years? Like, what is the optimal number here of like how long should I be contributing to this insurance policy?
The reality is when we have this early offset, two things are happening. First, we have to actually ask the insurance company to offset this early, because typically that's pretty early to offset a permanent life insurance policy. So they have to say, yep, no problem, you can offset. And then the second thing that happens is you're going to see something happen to the death benefit. The death benefit will slowly decrease for a long period of time until it starts rising back up again, which is something that kind of messes with people's head a little bit. The cash value will never go down, but basically what this means is for a period of time, they're cashing in death benefit in order to make this policy sustain itself. So that's why I always have a 10-year runway as sort of the goal. And that way, if you come up short, we can offset and it's no issue. But if you go and set all of your eggs in the 4-year offset or 5-year offset basket, and let's say anything goes wrong with your plan, now you're not yet at the break-even point, right? You just hit the break-even point. And, if you had to maybe cancel or something didn't go well, or you leveraged all your cash value for something, I would rather be more conservative, which, by the way, means the actual person setting this up, which would be us, would actually get paid less, of course, right? It's better if you have a much higher policy amount, but we actually would rather see our customers and clients successful over more of a 10-year runway and have you offset early than, say, run into some trouble where you're like, oh, shoot, I need to offset here. I don't have enough money because I sort of committed all of my retained earnings over these 4 or 5 years and something happened, just to give you a little bit of buffer.
So when you say something happened, meaning something happened and they had to do what?
Well, either
they had to cash that
they would either have to borrow against cash value to make their next payment, or and what I mean, if something happened, like let's pretend your business went under, you got sued, the business got sued, like you're cash strapped. Now you're like, oh shoot, you've got two options by, say, year 3. You've funded $3 million. I could cancel, take a $95,000 hit in this particular case, or I can borrow against this amount to keep this thing going to try to get it to the next year. But again, it's a place that adds one more layer of complexity if you've already got Armageddon happening in your world. So I would say having a little extra buffer to get you past year 5 is going to be a more conservative approach.
And having everything concentrated in this scenario here with 4 years as opposed to a 10-year runway, the reason the death benefit decreases is because the insurance company is drawing from the death benefit to fund the premiums?
Yeah, because remember we talked about when they design a policy, you were saying, so does every policy design it to age 100 for cash value and death benefit? The same's true here, that the actual actuaries in their minds, when they're designing a policy, they're picturing a 10-year or better runway. So you'll notice that here at the 10-year mark, if I offset at year 10, my death benefit's actually not going to really be affected. It's just going to keep going up and up and up. Whereas if I go anytime sooner, it's sort of like, it's almost like the actuary is going like, oh, that's not really what we were imagining in our minds. We assumed you were going to pay for at least 10 years. If you pay for the rest of your life, as you see here, obviously this death benefit's going to just balloon, right? Like crazy, of course. So basically the nuance is they're going, it's a permanent policy. They anticipate that you're going to pay into it for at least a significant runway. That significant runway is typically a 10-year runway or more in their calculations. But by having the earliest offset option, they're basically saying, listen, we're here to work with you, make sure that you can keep this policy. But what we thought was going to happen with your death benefit, it's not going to be quite 20 million. We're going to have to actually lay up on that for a little bit of time. And then it's eventually going to grow again, though, even though you're not contributing. You'll see it gets back to 20 million, but it's going to be in the later years by the time it gets back to this place.
Okay.
All right. Now, this question is, how long does it take to set this structure up or get it into place?
How long does it take for everything to get into place?
Yeah, great. Yeah, great question. So I would say, let's imagine that if you were like today, even though today you're not saying that, but imagine you were like, hey, Kyle, I've gone through this. I understand. I feel good about it. And I want to get the process going to get an approval going. What ends up happening is you send us we have a form you complete with your medical information and all the fun stuff, your details. You send us your financials, right? So we get your tax returns, your corporate financials and so forth. And then we hop on an application review call, make sure we have it inputted all correctly. You say, yep, good, everything's good. We send it off. And then basically underwriting can take anywhere from 2 weeks to some cases, it could be 4 or 5 weeks, depending. Sometimes they come back with some questions. They will potentially come back depending on the policy size and ask to do a medical. So they'll send a nurse to call you and say, hey, we'll come to your house. We'll check your vitals, make sure everything's good. And then it goes back to the underwriter. And then when they come back, they say, yep, approved, or no, not approved because of X, Y, or Z, or somewhere in between. That they're like, you know what, we'll approve you for this much, not this much, those types of things. But usually we can sense those ahead of time. We do pre-underwriting. And if there's any red flags we notice, then we let you know ahead of time. So
this is also a common question I think we all have as investors, is to think about, hey, if I do this particular strategy or I use this particular structure, am I too old? Is it too late for me to do this? Like, is it optimal for a young person, an old, like a middle-aged person? Like, what is the is there an upper bound here that I should avoid? Now, just to set some context, this particular client is in their late 40s, early 50s, and they're wondering if this is too late for them.
So where is so I guess obviously if someone were to look at this, the younger they start, like if I had this conversation with you 10 years ago, it obviously would be better than having it today.
Yes and no. And I would say the reason I say no is that the first couple of years for everyone is not fun. It doesn't look fun. So it is a longer term strategy. I always say having like a 10-year runway. Like this person has a 10-year runway. So this is kind of the numbers that we were working with. But it's really difficult for people to kind of get going, especially the younger you are, the less likely you're going to start this thing. Why? Because you're at a phase in your life where something like the death benefit might not be nearly as interesting to you. The other part is that you might think, I need all this money in my personal pocket in the early years. Part of why you kept some of this money in there was probably like, what if I have a bad year? Like what if what if this, what if that, what if the kids need this? What if the kids need that? So while it can look a little better, this person's 51, but if I show you, I can pull up one that's, I did one for a 36-year-old. Over the long run, he's going to have maybe a little slightly better scenario because he's a little younger. Or this is a female, 38-year-old female. Once again, this person, whoops, let me look at this one. Here it is. So that's the minimum they can put in, but they were planning to do 100,000 per year. But you can see here, look at that. It's, we still have that early year pain. Notice they hit the break-even point slightly earlier, right? Yours was like slightly closer to year 5. This one's at year 4. So slight improvement. Not massive, though, in terms of how this will play out. The vast majority of our clients are in their late 40s and then primarily in their 50s when we do this type of strategy.
Okay, those are 7 questions that business owners, entrepreneurs, high net worth individuals ask about using a whole life insurance policy as a pass-through structure for building wealth and optimizing their taxes. Sometimes we have to kind of hear responses, hear those questions asked by others to kind of how let it sink into our own understanding. And the more information we have, the better decisions we can make. This particular, structure isn't for everyone. It is for, say, certain individuals, certain business owners who are looking to, optimize their tax savings, but at the same time build their wealth by buying assets. And if we want to do it in the most tax efficient way, this is the move. In our previous episode, we got an episode that outlines like you can't be better off using a different structure. This is the ultimate structure you're going to want to use as a business owner who has a good amount of retained earnings. And you might be wondering, like, what is the right amount of retained earnings? If you're not sure, reach out to us. Reach out over at CanadianWealthSecrets.com/discovery. We can sit down, look at your unique situation, and decide if this is the right structure for you. We can look at all other alternatives if this is not the right structure. If you are looking to take a deeper dive, like you want to learn more about this structure, then we encourage you to enroll in our free masterclass. We put together and built a masterclass to educate you from start to end on how to unlock tax-free cash flow from your Canadian corporation. We've got walkthrough videos of why this is an important problem to solve, how to solve that, which tools, which strategies to use. And other important information in that master class. You can enroll for free over at CanadianWealthSecrets.com/masterclass. CanadianWealthSecrets.com/masterclass. Just as a reminder, the information you heard here today is for information, educational, and entertainment purposes only. You should not construe any of the information you heard here today as legal, tax, investment, or financial advice. Please seek your appropriate financial advisors for accurate advice.